The markets found a moment of respite today, but beneath the surface of the green screens, the atmosphere remains thick with hesitation. While the S&P 500 managed a modest gain, it wasn't a roar of confidence, but rather a quiet sigh of relief as the immediate panic over AI-led industry disruption began to ebb. We are seeing a market that is trying to find its footing. After weeks of being haunted by the idea that new technology might render existing business models obsolete, the focus hasn't shifted to aggressive growth yet. It's still very much about damage control and surveying the wreckage of the recent sell-off. Capital is moving with surgical precision. Meta's massive commitment to building out its data centers provided a necessary lifeline for Nvidia, reinforcing the narrative that the AI arms race is far from over. At the same time, we're seeing heavyweights like David Tepper's Appaloosa increasing their stakes in key semiconductor players. This isn't broad-based optimism, it's a calculated bet on the infrastructure providers, the picks and shovels of this era. While the software layer remains under intense scrutiny, the market is no longer buying the AI dream in its entirety. It is selectively rewarding those who hold the tangible blueprints of the future. There is a striking disconnect between the professionals and the public. According to Citadel Securities, retail investors have been buying the dip in software stocks at a pace not seen since 2017. While hedge funds and institutional desks are de-risking and questioning long-term valuations, the individual trader is stepping in with unprecedented scale. This is a classic test of nerves. The retail crowd is betting that the AI scare is overblown, providing the net notional demand that is currently keeping the floor from collapsing. It's a high-stakes standoff: retail conviction versus institutional skepticism. The January FOMC minutes remind us that the Fed is far from declaring victory. Almost all officials agreed to hold rates steady, but the internal dialogue is far more fractured than the headline suggests. A few members are still pointing to the risk of inflation staying stubbornly above target, even suggesting that hikes could return to the table if needed. The employment floor has stabilized, which perversely gives the Fed more room to stay restrictive for longer. The market is holding its breath, realizing that the pivot everyone hoped for is still being held hostage by the specter of persistent price pressure. We are approaching a massive technical inflection point this Friday. An estimated $3 trillion in options notional value will expire, a record for any February. A staggering sum that forces market makers into complex hedging maneuvers. These mechanical flows often act as a magnet or a trap for price action, with GDP data and the PCE index arriving at the same time. Any surprise in the economic narrative could trigger a violent deleveraging or a forced short squeeze. A market is not just trading on earnings, it is navigating a minefield of structural positioning. The consensus among the most seasoned analysts is shifting. The era of the rising tide lifts all boats is over. We are entering a definitive stock pickers market, where the gap between AI winners and losers will widen into a chasm. The market has bent, but not broken, yet the next catalyst is still missing. As we look toward the PCE data and Nvidia's upcoming results, the strategy is no longer about betting on the index. It is about identifying the companies that can maintain margins in an environment where capital is no longer free, and the promise of technology must finally meet the reality of the balance sheet.